When examining where this artificial intelligence stock could stand 5 years from now, the financial data tells a remarkably detailed and optimistic story. Palantir continues to demonstrate strong operational momentum as the artificial intelligence market expands deeper into government operations and commercial industries. Rather than slowing down, the company appears to be strengthening its position as organizations increasingly rely on data-driven decision-making to remain competitive in an evolving global landscape. Palantir is an artificial intelligence-powered data analytics business named after the all-seeing orbs from The Lord of the Rings, a reference that reflects its core mission of providing comprehensive visibility into complex data environments. The company entered the public markets through a direct listing on September 30th, 2020. At that time, shares opened at $10. Fast forward to today, and the stock trades near $150, highlighting an extraordinary rise in market value over a relatively short period. This rapid appreciation underscores how strongly investors have responded to Palantir's growth trajectory and strategic relevance. Adding to its credibility, Palantir earned a spot in the Standard & Poor's 500 in September 2024. Inclusion in this major index marked a significant milestone, signaling that Palantir had transitioned from a niche technology provider into a core component of the broader United States equity market. This move also increased the company's visibility among institutional investors, potentially driving additional long-term demand for the stock. Much of Palantir's appeal comes from its accelerating growth, expanding profitability, and direct exposure to the artificial intelligence revolution. Investors have been drawn to its ability to scale revenue while simultaneously improving margins, a rare combination in the technology sector. The critical question now is whether Palantir can sustain this momentum over the next 5 years as competition intensifies and expectations continue to rise. To better understand Palantir's future prospects, it is essential to look at its operating structure. The company runs 2 primary platforms that serve different segments of the market. Gotham is tailored for government clients, while Foundry is designed for commercial customers. Both platforms are built to integrate massive amounts of data from multiple sources, allowing users to identify patterns, anticipate outcomes, and make faster, more informed decisions. Gotham has become deeply embedded within government operations. Most United States government agencies rely on this platform to support planning, intelligence analysis, and mission execution. As global uncertainty increases and governments prioritize data-driven strategies, Gotham's role becomes even more critical. Meanwhile, Foundry has gained traction among major corporations seeking to optimize operations, manage supply chains, and uncover hidden insights within their data. Large companies such as Apple and Walmart use Foundry to analyze business trends and improve decision-making at scale. From 2020 through 2024, Palantir grew its revenue at a compound annual growth rate of 27%. This consistent expansion reflects strong demand across both government and commercial segments. Importantly, Palantir crossed a major threshold in 2023 by achieving profitability. Building on that progress, its net income more than doubled in 2024, demonstrating that the company is not only growing, but doing so efficiently. Growth within Gotham accelerated as domestic unrest and rising geopolitical tensions led governments to sign new contracts for advanced analytics and intelligence capabilities. At the same time, Foundry experienced rapid adoption as more United States commercial customers turned to artificial intelligence-powered tools to remain competitive. This dual-engine growth model provides Palantir with diversification and resilience, reducing reliance on any single market segment. Looking forward, analysts anticipate even faster growth. From 2024 through 2027, revenue is expected to expand at a compound annual growth rate of 45%, while earnings per share are forecast to grow at an even more aggressive compound annual growth rate of 84%. These projections reflect expectations that artificial intelligence adoption will continue to accelerate across both public and private sectors. A major driver behind this outlook is the expanding role of artificial intelligence across industries. Governments are increasingly using advanced analytics for defense, cybersecurity, and infrastructure planning, while businesses are deploying artificial intelligence to enhance efficiency, reduce costs, and uncover new revenue opportunities. Palantir sits at the intersection of these trends, positioning it to benefit from sustained demand over the long term. Another key metric reinforcing Palantir's strength is its Rule of 40 ratio, which combines revenue growth with adjusted operating margin. In the most recent quarter, this figure reached triple-digit territory, an achievement that places Palantir among the top performers in the software industry. This ratio could continue climbing as the company improves pricing power and benefits from economies of scale as its customer base expands. Despite these positives, valuation remains a central concern. Palantir currently trades at approximately 186 times forward earnings, indicating that investors are already pricing in substantial future growth. High expectations leave little room for disappointment, and any slowdown could trigger volatility in the stock. However, if Palantir delivers on analyst forecasts, continues expanding earnings per share at a compound annual growth rate of 40% from 2027 through 2031, and eventually trades at a more moderate valuation multiple, the upside could still be significant. Under these assumptions, the stock could rise by roughly 50% to around $225 over the next 5 years. While this potential gain would not match the explosive returns investors saw over the previous 5-year period, it could still outperform the broader market. The Standard & Poor's 500 has delivered average annual returns of about 10% since its inception, and Palantir's projected growth could exceed that benchmark if execution remains strong. Even so, it is important to acknowledge that Palantir remains a volatile stock. The company must continue growing into its premium valuation while navigating competitive pressures and evolving market dynamics. For long-term investors willing to tolerate short-term fluctuations, Palantir's combination of strong fundamentals, expanding market opportunity, and strategic positioning within artificial intelligence could make it a compelling story over the next 5 years. In the end, Palantir's long-term outlook reflects a powerful growth narrative driven by the continued expansion of artificial intelligence across government and commercial sectors, as the company has already transformed from a $10 stock following its direct listing on September 30th, 2020 into a nearly $150 stock today, while also securing inclusion in the Standard & Poor's 500 in September 2024, signaling its rising importance in the broader market. Through its Gotham platform for government agencies and Foundry platform for commercial clients, Palantir enables data-driven decision-making by aggregating complex data sources, a capability that has fueled strong adoption among United States government agencies and major corporations such as Apple and Walmart. From 2020 through 2024, the company grew revenue at a compound annual growth rate of 27%, reached profitability in 2023, and more than doubled net income in 2024, with growth supported by increased government demand tied to geopolitical tensions and accelerating commercial adoption. Analysts expect this momentum to intensify, forecasting revenue and earnings per share compound annual growth rates of 45% and 84% from 2024 through 2027, supported by the broader artificial intelligence boom and reinforced by a triple-digit Rule of 40 ratio. Although Palantir trades at a lofty valuation of roughly 186 times forward earnings, if it continues expanding earnings per share at a compound annual growth rate of 40% from 2027 through 2031 and it transitions toward a more moderate valuation, the stock could still rise about 50% to roughly $225 over the next 5 years, potentially outperforming the Standard & Poor's 500 despite ongoing volatility.